day, folks. We are going to take a deeper dive into the financial markets, specifically equities, looking at risk, asset classes, and fusion analysis. These series of lectures and supporting information are not used in your application project, but will be the basis for the final quiz. First thing is, saving and investing are not the same thing. Saving is the act of putting money aside from your income for the future. That's saving. Investing is what you do with the savings. There's an important difference here. Because a lot of times, we're saving, and what are you doing with the savings? No. Saving is the act of putting money aside. You've got to take money from your income, put it aside for the future. Investing is what you do. Trading and investment are not the same. Trading is an activity performed in a very short period of time to profit from market fluctuation. It can be from seconds to months. Investing, on the other hand, takes a long-term view of the portfolio with the long-term goals of capital appreciation, income, etc. So trading can be buying and selling to try to take advantage of price movements, where investing is looking at the company, much as you've done this semester, and make decisions based on its ability to grow in the future. When we ever look at this, we need to stop and look at risk and return. Return is how an investment performs over a period of time. Risk is the degree to which an investor may lose on the investment. Okay? So there's a correlation between risk and reward. And it's a trade-off, if you will, is that the lower the risk, the lower return. The higher the potential return, the higher the risk. And it's often measured by a standard deviation of risk. Okay? So keeping this in mind, if something appears to be very good, there's most likely, 99.9999% of the time, there's higher risk associated with it. So whenever we see some of this information, we need to manage it within that context or understand it. There's different types of risk, and a lot of times we don't break that down. Hopefully in the risk management section you saw some. Let's take some very specific risks around equity. There's the market risk, the possibility of your investment decreasing in value. And that can happen based on business risk, the performance of the underlying business. You've looked at the fundamentals, something happens, and sales are negatively impacted, expenses, profit doesn't come out to what's expected to be, failure to implement a strategy. Then there is what we'll call event or macro risk. These are things that happen in the general economy and in the world, and as a result, they cause market values of equities to go down. There's two different things. The first is really around the company itself, and if you will, the company is sort of part of that equation. A macro risk is something that applies to everybody that management really couldn't see. Okay? So there's event risk. So this market risk comes in two causes. Then we have inflation or deflation risk, and that's the chance of diminishing purchasing power in the case of inflation. Deflation is increasing purchase power. So we look at that as a risk over a period of time. And inflation is the rising cost of goods or services. If inflation runs 3% for 30 years, $100 worth of food today would cost $2.50. Deflation is declining cost of goods sold, cost of goods or services. Now, this is where you come in and the risk comes in, is that if you have an investment that is earning 1% and inflation is running 2%, over time that money becomes worth less and less. It's not keeping up with inflation. Other risks, liquidity risk, the risk of not being able to sell an investment quickly at a reasonable price. Now, on equities such as Apple, Microsoft, Facebook, these are all big companies that are listed and traded. There's a market around them. You might say real estate. Now, real estate has value, of course, but you can't sell it like now. A listed and traded stock can generally sell now. Then we have interest rate risk. Changes in interest rates impact the value of fixed income securities. Then there's the opportunity risk. By being invested in certain assets, you may lose the potential gain on others. Your risk, though, the balance, when you look at this from an individual perspective, and that's how we look for it, generally individual or a portfolio, if you're managing money, such as the Student Managed Investment Fund, is really to balance them around your time horizon. The sooner you need the money, the market risk is more important than the inflation risk. The longer the time period, the greater the inflation risk and the less the market risk. As an individual saving for retirement, your greatest risk is outliving your money. So when we look at risk, I would suggest you look at it that there's three areas of risk: risk tolerance, risk capacity, risk required. How much risk do you prefer to take psychologically? Okay, this is behavioral finance. Risk capacity, how much risk can you afford to take? And then how much do you need to take? So it's right in this sweet spot is where we are. So seeing risk in these different categories from an investor perspective is important. Then we have risk or volatility. Often we confuse the two of them. Volatility is more about short-term market swings and the depth of the swing. For example, two investments may each have a 5% annual return over a 5-year period. A may be consistent and have 5% each year. B may have 10% one year and negative 5% the following year. But overall, it comes out to 5. So we want to look at that. Is it moving? What are we talking about? You can invest in many things. But again, risks. What are the risks of the investment? What is your risk tolerance? When do you plan on using the money? Returns from investing come from current income, interest on bonds, dividends, rent on real estate. Capital gains are increase or decrease in market value for capital gains. Capital losses would be decrease in market value. And they can be realized or unrealized. Then we have the powerful effect of compounding, which you saw in a previous lecture, the interest on income. We have some general asset classes, and there's always a trade-off between risk and reward. And asset classes simply refer to a distinct type of investment or to a group of assets that share some common characteristics. So we have stocks, we have bonds, treasury bills, cash, alternatives. So stocks are equities. Then we have bonds, which are fixed income, treasury bills, which are short-term obligations of the U.S. Treasury. Then there's cash. Alternative investments can include real estate, commodities, oil, gas, feeds, gold, silver. And each one has its own unique risk and reward characteristics. Let's take a look at investing in common stock. This is probably repetitive, or many of you already know, but I want to keep things in context here. Each share represents equity or part ownership in the company, and investors participate in the firm's profits. Stock ownership is residual. Before the shareholder would get anything, all the other debts and liabilities have to be satisfied. The firm's obligations are paid first. Stockholders come second. We then have book value, and what you're seeing on the 10Ks that you look at is the book value. Then there is the market value. The market value is the number of shares outstanding times the price per share if it's publicly traded. Oftentimes there is a difference because book is a historical number where market value is an estimation of what the firm will do in the future. Voting rights. Common stockholders usually receive 1 vote per share. Most shareholders assign their votes to someone else to vote for them. Dividends are determined by the firm's board of directors. Cash dividends are usually paid quarterly. They can be paid even if a company shows a loss. From a basic tax consideration perspective, cash dividends and long-term capital gains are both taxed at a maximum of 5% if you're in the 10 and 15% tax bracket. Gains are not taxed until realized. Investing in bonds, fixed rate securities, interest rates, and bond prices move in opposite directions. So if interest rates go up, bond prices go down, reflecting the fact that a bond, when it's priced, is always for the remaining maturity of that bond. They're very versatile. Focus more on the preservation and long-term accumulation of capital. There's lower risk and rather than stocks. However, they're not risk-free. You have interest rate risk and you have credit risk. So it's a different class. Bond issue characteristics, they're like a loan. Bondholder lends money to the issuer. Interest is usually paid every 6 months. Coupon, annual interest rate paid by the issuer, may not be what the yield to maturity is when you buy a bond. A bond maturity is when the loan pays and the issue comes to the maturity, and the bond issuer pays the principal back to the bond holder. The bonds do not generally have any principal repayments until the due dates. Alternative investments are all over the place, so whether that be real estate, commodities, currencies, it's all there. So that's a little bit of it, and this will end this video, and we'll come back with another video as I'm trying to keep these short. If you have any questions, please let me know.